I am curious, Michael, whether you think that you're going to end up with a big pushback this week from Fed Chair Jay Powell, regardless of what he says, with people going about their business and continuing with the disinflation kind of trade.
Big pushback? Probably no, right? I mean, the big pushback is what's more important, what you do today or what you say you're going to do tomorrow? And if they're slowing down to a pace of 25, it's hard to, I think, push back too strongly. So, I mean, I think that they will reinforce their message and repeat their message, but I think it's hard to be hawkish and strong when you just slow down again. So the policy action suggests they're more comfortable with the outlook, they're more comfortable with where they are. Pushing back, and at that point by saying, no, we're going to be super hawkish, it's hard to do that.
So I remember a long 6 months ago when people were really talking about the potential pain, including Jay Powell, to markets, to the economy, if you have both rate hikes as well as a balance sheet runoff. We're talking about rate hikes and how perhaps we're at the penultimate peak of them, or whatever you want to call it, if you're Stephen Major over HSBC. But no one's talking about the balance sheet anymore. Should we be?
I think we're going to get to that point. So if the Fed is in a higher for longer phase, right, and they're saying, okay, markets expect more rapid disinflation, they're looking for cuts, fine. It's a different view of the outlook. We think inflation is going to be stickier. And you heard Governor Waller say, hey, we should consider continuing to run the balance sheet off even as we cut rates, right? I don't think that would be consensus. Like we and others, I think, are saying if the Fed eventually cuts rates, they probably stop QT at the same time. And I think Waller kind of threw out there for the first time, maybe not. Maybe we run the balance sheet off for longer. So you get more combined tightness out of the funds rate and the balance sheet.
Have we seen it yet, the tightening from that particular effort?
Yes. I mean, the markets build all of that in advance, right? I think if you're a stock person versus a flow person, you think, well, how much total cumulative runoff of the balance sheet are we going to have? Therefore, how much are markets going to have to absorb in Treasury debt? This would be a way of saying, hey, maybe you didn't think the balance sheet was going to run off as much as you thought, right? So you might get you reevaluate your expectation of just how much Treasury debt the market's going to have to reabsorb.
Another way of asking this is, when do we start to see the peak influence of the tightening cycle in economic data? Have we already started to see most of it or a material amount of it, or will we only see it 6 months from now?
I think we're literally just getting to the point where we're seeing it. I think that historically, and the modeling would tell you it takes at least 12, if not 18, maybe even up to 24 months to see the cumulative effects of tightening come through. So conditions started to tighten in March and April of last year. We're in the first quarter again. So I think it's really still in front of us. So I think there's more to come. And I think that's why most of our growth expectations for 2023, soft landing versus hard landing, are still weaker than they were in 22.